On today's Capitalist Investor, we are going to talk about 3 investment opportunities that you'll only hear from high-end financial planning firms. These aren't your average 401k picks. We are going to talk about 3 strategic investments used by top-tier advisors that help build serious and diversified wealth.
All right. Hey, Tony, how we doing today?
Good, man. How you doing?
Oh, can't complain.
All right.
Just watching the tariffs on Switzerland. It's coming down to the wire.
Yeah, I don't know why. I don't know how they got in Trump's bad graces or crosshairs, but somebody seems to every week.
Yep.
It just happens to be Switzerland.
Mm-hmm.
But anyway, all right, man. We're going to talk about some investment opportunities that most people don't have access to if you're kind of doing it on your own. Mm-hmm. These are investments that are meant for firms that have, a lot of money under management, typically maybe $1 billion or more under management. And because of the asset size of a particular financial planning firm, they get access to bigger and exclusive funds that don't even trade on the stock market. So we're going to talk about those because when it comes to building a prudent investment plan and retirement plan, more diversification outside of stocks and bonds is really what it is, because at the end of the day, we want to limit volatility. Right. And the more non-associated asset classes that you have is going to help accelerate actually your investment strategy. Because I've always said, I'm like, hey, if your account's down 10%, you got to get maybe a 12 or 13 to get back to even. Mm-hmm. But if you're down 30%, you need like 45 to get back to even, right? Or maybe even 50%, right? So you don't want to crawl out of these holes. It's easy to get back 10 or 12%, not 50. So we're going to talk about some investments that help with diversification, and again, and they're outside of the standard stocks, bonds, and mutual funds. So the first one we're going to talk about is private credit, and the way I would describe this is, this is how our investment team talks about it, is they have a strategy and target income and capital appreciation by primarily investing in privately oriented and negotiated senior secured loans in U.S. companies. Investments are primarily focused on the middle market of companies that have revenues between 100 million and $1 billion. So let's put that in English, right? Essentially what private credit is, there are firms, or not firms, but there are companies out there, usually non-publicly traded companies, and it could be traded public companies, but they might, I'm going to use a crazy analogy. So let's say Microsoft. I'm sure they got war chests, they got money sitting around, all this stuff. But let's say they wanted to build a new headquarters, and they needed, $5 billion. They ain't going to JP Morgan. Like, it's going to be very hard for them to secure that type of loan. And again, I'm using crazy numbers just to kind of give you an analogy. So what a private credit fund would do is they're going to start pooling investors' money. So they're going to take my money, Derek's money, our engineer Chris's money over here, hundreds and hundreds of people. They're going to take our money and they're going to put it out to other companies that need to invest in money that can't get secured loans from banks, because either the bank, maybe they're already kind of levered up, maybe the banks just don't have the money to lend, whatever that may be. So they take our money and give it to this company. But because it's outside of a bank, they charge a higher interest rate. Okay, so let's put that in perspective. And the type of private credit funds that we do look for are the ones that secure the loan with assets. So they tie it to buildings, equipment, things like that. So if the company goes belly up or they start having a hard time, they take over the company and they sell all the assets and they recoup their money that way. So that's my kind of high level wonky analogy to describe what is really happening.
Yep.
It's obviously a lot more sophisticated than the way I laid it out, but now you can kind of get a sense of what is happening.
Yep, for sure. Yeah, it's this sector of the market really came about back in 2008, 2009, and all the legislation that was passed, after the global financial crisis, as it related to the housing market. So the standards got raised for how who could borrow money, how much they could borrow. So these funds became a huge part of that kind of middle tier business. But we should mention, middle tier business are still usually giant businesses, right? They're a lot of them, like Tony said, aren't even publicly traded. A lot of them are backed by private equity.
Right.
So we'll talk about that too. But what that means for the investments is that, private equity, who owns a particular company, is not going to let that company go belly up, just because they start missing payments. They obviously have a longer term investment in that company. So, while it may sound, I don't know if dangerous is the right word, but while it may sound more complicated than just going out there and you buying a government bond, the risk return profile that you get from an investment like this is actually much better than just your standard old bonds.
Yeah, it has a risk profile like a treasury, but gives the yield of a higher than a high yield corporate bond.
Yeah, for sure.
So like we've seen some of the statistics behind this, or I guess the investment history of it. Like let's take like COVID or 2008, the banking crisis, 2008, 2009. These like a bonds and fixed income. So like this private credit that we're talking about is more in that fixed income category. And during those bad periods of COVID in 2009, fixed income was down 15 to 20%. A fund like this was down more like mid-single digits.
Right.
And right now they're currently, some of the funds that we have seen are yielding anywhere between 7 and 10%.
Right.
I'm going to continue to reiterate through everything that we talk about. We are talking about a lot of the pros. Again, one of the cons, though, when you start dealing with private placements or alternatives, is liquidity. It really is. Like you can't buy it today and sell it next week or next month or next year. Sometimes you have to wait for quarterly distributions,
right,
or quarterly redemptions. And sometimes the companies say, no, we got other plans in mind, and we are not giving you your money.
Yep.
So these are long-term investments, and they are meant for, I'll call them slivers or slugs in your portfolio, anywhere between 2 to 5%. And again, and sometimes they're not even meant for everybody. So we're going to dive into that a little bit later. But every time I'm going to talk about this, again, all of these investments sound great, but they may not fit your either risk profile or your investment profile.
Yep, for sure. Yeah, we'll keep reiterating that as we go through. Right. I'll wait for Tony to dive into that first. But yeah, definitely not for everyone. Like all investments, you need to make sure that they fit your specific profile.
Yep. The next one would be like private REITs. So investing in real estate.
Yep.
Now, I have seen in the past, and particularly like people have gotten into like these private REITs back in 2004, 2005, and they just got wrecked.
Yep.
I've seen this. It actually scared me for the longest time to invest in private real estate.
Right.
Because it was, they were high commission products that were being sold for, let's just say like you bought a share for $10 and three or 4 years later it was, so illiquid that people were offering $1 for the $10 you. I mean, you just got wiped. right? But and people were investing on the promise that they would have these high yields, and that's what real estate really is. Like we have to understand that real estate is not liquid, right? They don't buy a building this year and sell it next year. They buy the building, they make capital improvements, and they fill the building, right? That's the biggest crux of real estate. So we want to find companies that are buying quality buildings and where they're filling these buildings, right? And they have a history of doing that.
Right.
So they're investing in commercial real estate. They're typically maybe like a triple net lease, where essentially I own the building, but my tenant takes care of everything else,
right?
Repairs, utilities, everything, taxes. Like you're just sending me a check to rent the space, right? Essentially, again, I kind of bring all of like the high technical talk down to how I can explain it, but it's essentially I own the building and you take care of the rest. Just send me a check every month. But this is like you got to find those types of companies that are investing in multifamily homes, apartment buildings, because think of how the current housing industry is. It is hard for new people. If you've never owned a house before, it's nearly impossible to buy a house because of interest rates and the fact that we actually don't have enough houses, right? They need to continue to build them, but everything has doubled in the last 8 years on housing. If you bought a house for $250,000 6, 7, 8 years ago, it's doubled. It's $500,000 now. So people need places to live. So looking for those places that are doing apartment buildings, multifamily housing developments, things like that. So what are your thoughts, Steve?
Yep. So, like Tony, we grew up in the business seeing these REITs just getting absolutely destroyed. So it is important to note the distinction between just a regular old REIT and private real estate, what we're talking about. The easiest way I like to explain it is a REIT is basically a stock that owns real estate. Those are based a lot on value. And that is the primary reason they got trashed so much in the early 2010s, coming out of the financial crisis, because the value of the real estate just got crushed, right? A lot of these investments that we're talking about, especially for high net worth people, these become income streams for them.
Yep. Same thing like the credit.
Yep.
The private credit. That's exactly what real estate does too. It might not appreciate as sexy as a stock,
right,
but it's generating the income that is, again, a diversifier inside of a retirement portfolio.
Yep. So, for example, like you could own, because I've had diamond hands on this one for a long time. I'm just too lazy to sell it, I guess. But like Pulte is a home builder.
Yeah.
We almost bought like a condo, before in 2012 or something like that from Pulte, and so I knew the name and I invested in it back then, and it's done really well. They're building homes, doing stuff like that. This type of real estate is meant to be kind of level, a nice level price of the investment, and throwing off, like a nice 8 to 10% income stream per year. Yep. That's what you're really looking for on these private investments. The private real estate, I should say. They obviously blew up in 2021 and 2022 when the values of the homes and the different investment properties were going through the roof. We saw a lot of capital appreciation there, but it is meant, like Tony said, to be a diversification piece and an income piece. Something that we know is going to be stable and throw off a nice income. And again, to be able to get into an investment like this, you need to have really great liquidity, right? You have to have the ability to take that chunk of money and say, hey, I don't need the chunk, for a long time. What I do need is the interest and the income that comes off of it. I'm going to spend that but the investment that you put in, that is going to stay put. And like Tony said, you can put in for redemptions, right? And if no one else is putting in for those, you could probably get a good chunk of your money back.
Yeah. Again, real estate's not very liquid,
right?
And so the redemption on this side again is the liquidity side of it. But you do want to look for those stocks, or not stocks, but these these REITs that are right now, like looking at like hospitality, looking at self-storage, right? These storage places they build them and they fill them, right?
Self-storage is such a scam. I rented a storage unit when I redid my basement, because I had just a small portion of it.
Yeah.
And they lock you in, and then they just give you price increases when all your stuff is there. So like you can't move it out because you need the storage, but they just give you price increase after price increase. It like doubles the price in like 6 months.
Really?
Yeah, it's crazy.
They don't have a contract like 12-month locked in?
No locked in.
Month to month?
Yep. You just get a random email that says, oh, your rent's going up 20%.
Oh, yeah, every month.
It's a good business to get into.
And then data centers, right? With AI, housing all of this hardware, right, is another thing. So again, keeping your eye on what the REIT is actually investing in the brick and mortar facilities that they're pumping their money into. The next one is private equity. And what private equity is there's a lot of companies, successful companies, quite a few companies actually, that are privately held. They're not publicly traded. They could be between $15 million revenue to $250 million revenues. They're pretty much a micro stock, buy-in, yep. Right? And again, how does this work? They take money from me, from Derek, from our engineer Chris, pull this money together, and then they buy into a company. Do they buy it all? Do they buy a portion? It all depends on how the deals are struck. But they essentially go in and retool the whole company, help take a $50 million revenue company, which is a great, fantastic company, and take it to 250. Because maybe that owner just got landlocked, right? They got locked. They can't maybe get out of their own way. They need capital infusion. They need higher brain trusts, right? People in the room that have taken companies bigger and know how to scale and how to do this. So like that is what is really the good part, because these PE firms are not going to come in without doing their due diligence and see the opportunities that are being missed by maybe current owners. Now, and also because they're not publicly traded, there are less restrictions than publicly traded stocks, yep. Right? These PE teams can come in and make huge waves without disrupting stockholders, publicly traded stockholders, things like that. They're okay with maybe even going backwards for a year or two so that they can accelerate going forward.
Yep.
So I think that's a good way to describe it. Dee, how do you look at this?
Yep, it's again back in 2008, 2009, lots of companies going out of business. Even before the tech bubble in 2000, 2001. The result of that is it became a lot harder to become a public company. And frankly, a lot less desirable too, right? Obviously, taking if you create a company and then take it public, when you take it public, that's how you get super rich. But being a CFO for a public company, is just a very, very difficult, stressful job. With your, frankly, your freedom on the line because of all the penalties that they started attaching to, rightfully so, people, companies that were taking advantage of public trust. But long and short of it, there's a lot of great companies that you just can't go to the stock market and invest in.
Right.
And that's what really this private equity sleeve comes from, is getting invested in those companies.
Yep. And so, as we kind of wrap up this show, we're, why don't a lot of advisors offer this, right? And you have to understand how that financial advisor, how they run their business. Do they run it as like an independent RIA or registered investment advisor like us, where we're a fiduciary and we're fee based, or do they run their business like a a commission-based type of firm where they have to clear through a broker-dealer, things like that. As us, we clear, our clients' assets are held at Schwab or Fidelity, Interactive Brokers, wherever it may be, but we're fee-based. We can't accept commissions. And when we advise on these and it makes sense for a client, it's just part of the AUM fee. There are no commissions up front to me. There's no commission losses for the client.
Yep.
And also compliance. Like these are non-traded securities. They're alternatives. So like I can't just go on Schwab and buy them.
Right.
I have to fill out paperwork. I'm going to give them my money. That money might sit for weeks or months until they find the opportunity to invest in.
Yep.
Right. And again, they're not commission heavy. So sometimes financial advisors they're not motivated to put a client into it. And that's where the fiduciary versus the suitability standard comes into play.
Yep. And it's one last thing. The reason why, firms like us can get into these products is really because, we can kind of pool. Your funds don't. Well, I guess they all go to the fund, but the minimum requirement. So if you were just a person off the street and you wanted to invest in a private equity fund, the hurdle to do that is very high. You'd probably have to do $250,000, $500,000 investment here. Because we're a firm with clients, we can kind of aggregate to get to that number, so you can get a smaller initial investment and still get into that fund.
Right.
So that is important, but also also important to note that a lot of these investments that we talked about are meant for portfolios probably of $1 million or more. Again, if you wanted to get off these investments, just off the streets, you would probably have to be an accredited investor.
Yeah.
So you don't usually have to have that requirement when you get them through firms like us.
Right.
An accredited investor is typically $1 million of liquid net assets.
Yep. And as final thoughts as we wrap this up, again, these aren't for everybody, right? We have to use them properly to unlock the advantages of it, because maybe the asset size isn't there. Derek mentioned, $1 million and above. Distributions, right? Like how you could still get into these if you have $500,000, but you better have some in retirement. You better have enough income sources where we don't really have to aggressively take distributions from the accounts, because again, these are long-term investments. They are usually rather illiquid on a short-term basis.
Right.
I think I was working with a client. We got into the REIT. We really liked it. It made a lot of sense. And then he just had an opportunity that he couldn't pass up. He needed to liquidate the accounts to buy some property that he's been looking at for years and years and years. And finally, the deal came through. It took us maybe 6 to 9 months to liquidate, the real estate side, right? Because it is like, in one quarter they told us no, so we have to size this appropriately and figure out which, if not all of them, if we want to implement those. And then also, it could be a pro and a con. Volatility. These aren't home runs, right? They're singles and they're doubles.
Yep. Because
they're going to generate great income. They're going to be steady performers over a long period of time. So if you're looking for 20, 50, 100% rates of return, this is not it. If you're looking for steady, high single-digit returns over a long period of time, this could be it.
Yep.
So that's, again, figuring out your asset size, your distributions, and it all comes to financial planning. Does this fit into your plan?
Yep.
So.
Well said. Yep. And I think these can definitely be discussed as part of your overall portfolio, but definitely need to fit in there properly.
Yep.
But it's any investment that we look at for our clients, it comes down to risk adjusted return, and that's what we're looking for, is to increase the return for risk that we take.
Yep.
So. Well, great topic this week. Thanks everyone out there for listening. If you guys have any questions, ideas for a show, Hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.